It seems like no matter what you do, you can't escape the unending march of geopolitics as an investor, and the start of 2026 was no exception to that. They say that spies on the ground had learned just about everything there was to know about Nicolas Maduro, and they knew where he ate, where he slept, and what his routines looked like. Then, when the US decided the time was right, it launched Operation Absolute Resolve. The explosion started in Caracas, the capital of Venezuela, around 2 a.m. Then, the city was plunged into darkness. And in what turned out to be a massive operation for the United States, they captured and whisked away Maduro to New York. Let's be real. I think just about any rational person can agree that it's a good thing that Maduro is out of Venezuela. The guy had continued the terrible reign of Hugo Chavez. Venezuela was in the midst of an inflationary crisis. But as investors, we have more on our minds than just the social and geopolitical issues related to this event. The question for us is, what does it mean for energy companies now that President Trump says we're going to, quote, run Venezuela? After all, Venezuela has what many claim to be the world's largest proven oil reserves at over 300 billion barrels. It's possible that you've heard that was an inflated number created by Chavez for the benefit of Venezuela's standing with OPEC. But it's worth noting that number is also the estimate used by major oil producers and the CIA. So, for the purpose of this, we're just going to take that at face value, with the understanding that Venezuela is one of the most oil-rich nations on earth. Unfortunately, the country's continued economic turmoil means that it's producing nowhere near what it possibly could. In fact, Venezuela has failed to bring on any new production projects since it nationalized its oil in 1975. Now, investors are clamoring for the opportunity to get in on the action, and it's no surprise considering the big claims that President Trump has made. They've ranged from everything of us getting a cut of the current oil production to heavily subsidizing the energy industry to bring new production online in Venezuela. But there are other major headwinds there too. Venezuela produces what the industry refers to as heavy and sour crude. Put simply, Venezuelan oil is expensive to produce, significantly more expensive than the oil that they pump out of the ground in the Middle East. It means that getting Venezuela's oil industry up and running would take significant investment, and don't think that the oil majors are rushing to get in on the action. Heck, ConocoPhillips is still owed roughly $10 billion according to their own accounting. When you put it all together, the only real answer that we have right now is that the whole situation is a mess, and that almost nobody knows exactly what the outcome will be. Fortunately, you don't have to be an industry expert to take advantage of changes. That's because the Power Gauge helps investors by revealing what's really going on inside of the sectors, subsectors, and the company themselves related to this event. We'll start by looking at the State Street Energy Select SPDR ETF. This ETF holds roughly 22 stocks and is representative of the energy sector as a whole. Now, you can tell by looking at the Chaikin Power Bar that there are 5 bullish stocks, 13 neutral, and 4 bearish. And right now, the ETF as a whole earns a neutral rating from the Power Gauge. Looking at the chart, it's obvious that if Wall Street sees a major opportunity headed in the energy sector, it's not acting on it yet. The ETF as a whole has underperformed the S&P 500 for the last 6 months, and we see that the Chaikin money flow, our measure of institutional buying and selling style activity, has been spotty and down in most recent weeks. The picture looks even more grim when you dive into the State Street SPDR S&P's Oil and Gas Exploration and Production ETF, XOP. Geez, that's a mouthful. Put simply, this is how we look at oil and gas exploration and production. And you can see that in this group of 51 stocks, only 12 are in a bullish or very bullish rating. 9 are in the bearish category and 29 are stuck in neutral. Looking at the chart, it's obvious that Wall Street is not acting on any significant opportunity here. The ETF is down roughly 3% over the last 6 months. It's severely underperformed the S&P. And once again, Chaikin money flow shows that money is not pouring into this ETF. When we look at the Chaikin pre-trade checklist for XOP, we see that now is absolutely not the time to be making a big bet on the oil and gas production and exploration subsector. The power gauge rating is bearish. It's underperforming the S&P. The industry group is weak. The long-term trend is weak, and money flow persistency is weak too. Listen, I want to be really clear. I'm not trying to make some kind of political statement here. All I'm doing is looking at the data, and folks, we all know that the smart money tends to signal first before the news catches up with it. Put simply, if Wall Street was buying into the energy sectors and subsectors, we would be seeing it on the chart, in the data, but we're not. It wouldn't be fair to Chaikin Analytics subscribers to give you all the ratings of the stocks inside both of these ETFs. But I do think it's important to know that I've sorted the energy sector stocks by market cap. That means we're looking at them from biggest to smallest in terms of how the market values these companies. And the data is as clear as it gets. Nobody is soaring ahead of the pack here, and nobody is dramatically outperforming the S&P. That said, we are seeing some signs of life. And once again, the power gauge makes it easy to spot. Let's use ExxonMobil Corporation as an example. Here, you can see that it currently earns a neutral rating in the power gauge. Its financials factor category is neutral, technicals is bullish, but earnings and experts are bearish. When we look at the chart, we see that the stock has been trading comfortably at or just above its long-term trend line for the last 6 months. But that doesn't mean it has been a winning stock for the majority of that time. You see, it has dramatically underperformed the S&P. But here's where things get really interesting. We see that it began to outperform the S&P using our proprietary relative strength measure right at the end of December, before the world knew publicly that the US was about to take over Venezuela. We also see the littlest blip in smart money buying activity around that same time. So, is it possible that Wall Street knew something was about to happen in the energy markets and chose to place a bet on Exxon? That's definitely a possibility, but as you can see on the chart, this isn't a huge, strong trend change. Folks, the old adage goes that when there's blood in the streets, that's the time to invest. And sure, there was literal blood in the streets of Caracas when the US captured Maduro. But the simple fact is that as of right now, the energy sector is not signaling a major breakout. And right now, Wall Street seems to be more considerate of the headwinds this sector is facing than the potential of a Venezuelan oil payoff that could take decades to materialize. That's the thing. This doesn't mean that Venezuela is not a strategic asset for the US. It simply means that this is not the kind of thing that's driving stock price action right now. And as investors, differentiating between those two is one of the most important things that we can do. Every day, the mainstream media bombards us with stories. Most of them are as dramatic as they can possibly be, and the news is always pushing us to be afraid or to see a major change as the most important thing that's happening in the world. The reality is that Maduro was a turd and a dictator. Maybe you would have gone about his ouster differently. I have my own opinions on that, but there's no question the US has been incrementing towards this kind of an outcome for a long time. Despite that, it doesn't mean that it's going to usher in the proverbial gold rush in the energy sector. In fact, since the start of the year, the energy sector is nowhere near the best performing top-level sector in the market. Looking in the power gauge, I see that so far this year, the top 2 performing sectors have been the materials sector and consumer discretionary. That means that even with the dramatic news, the market has focused its attention elsewhere, and the power gauge is telling us that we should do the same. I hope you've enjoyed watching this video and that you found it informative. If you did, please give it a thumbs up and feel free to subscribe if you'd like to see more content like this. And if you'd like to try the power gauge for yourself, click the link in the description. My team has set up a special version of the power gauge that lets you search 3 tickers a day for free. Doesn't require a credit card or any funny business like that. Simply put in your email to create an account and you can start using the power gauge for yourself. Stay safe in these volatile markets. Before you trade, make sure you check the power gauge. Good investing.